Okay, so we will be covering ratios in this particular session. So this is the ratio sheet that has been given. This is from CFA module for level 1 financial statement analysis, LOS 37 ABC, right? So it talks about ratios. So first, if you look at this particular if you look at this question, it gives you the balance sheet and P&L of Sedgwick company, and we need to do a comprehensive ratio analysis. So the best way to do it is create a matrix for all the ratios. So we will start with liquidity, and liquidity we will start with current ratio, which is current assets divided by current liabilities. So in this question, your current assets, let's do it only for the current year. In fact, do it for the previous year also. Now, if you look at the current year and the previous year estimates, the current ratio in the previous year was 580 divided by 275. And in the current year, it is 620 divided by 325, which means there is a decline in the current ratio. There is a decline in the current ratio, and this decline basically measures it's very early to say anything until we look at other ratios in conjunction also. So I would not be commenting directly on the decrease unless and until I also see the current ratio, I mean the quick ratio and the working capital position. But overall, it is in the range of 2, which is healthy in terms of liquidity. Now, as I mentioned, for arriving at quick ratio, we need to remove the inventories, which is a slow moving current asset, and prepaid, which is not at all recoverable. It's more of an expense which is deferred. In this case, we don't have a prepaid. So your quick ratio will be, for the previous year, it will be 580 minus 290. So that itself tells you that 50% of your current assets are inventories divided by current liabilities. So that's a ratio of 1.05, which is again healthy because the quick ratio is normally considered to be 1, is a good benchmark. For the current year, it will be 620 minus 310. Again, 50% is your inventory. So that also is almost, so you'll see that because the inventories are 50%, because the inventories are 50%, so the quick ratio is half typically of the current ratio. And if you look at the working capital position for previous year, it is 580 minus 275. For the current year, it is 620 minus 325. So you will see that all the three have declined a little bit, all of them, right? But the decline is very marginal, isn't it? Very, very marginal in the current ratio, quick ratio, and working capital. But even though the decline is marginal, as long as there is no future decline and they are currently also at a healthy level, so they should not be a cause of alarm. So this is your liquidity assessment. We will now move to the profitability. So for profitability, it is obvious that we will need to look at the P&L in conjunction. So we will start with GPM, gross profit margin, which is 1,000. Now there is no previous year there, so we'll restrict to the current year. So 1,000 by 4,000, am I right? So which means that your gross profit margin is 25%. NPM, net profit, and rather we should take OPM first, operating profit margin, which is uh, operating profit 350 divided by 4,000, which is your revenues. Now here you will see a big drop. When you are traversing from gross profit margin to operating profit margin, you will see that the margins are decreasing from 25% to 8.75%. Now that is almost two-thirds of your margins are eroded. And that tells you that the operating expenses are relatively high. Then we will come to net profit margin, which will be net income. Now, do not reduce dividends and then put the NPM, because dividend payment does not really impair the ability of the firm to earn the revenue. क्योंकि सपोज आपने सारा डिविडेंड डिक्लेयर कर दिया, एंटायर नेट इनकम you have declared as dividend, that does not mean that your net profit margin is zero, no? You have earned and then you have distributed. So your net profit margin should be calculated before dividend declaration. So it should be how much? It should be 200 by 4,000, which is 5%. So आप देखोगे कि the reduction between gross profit margin and net profit margin is more severe, much more severe than between net profit margin, than between OPM and NPM. Between GPM and NPM, it is more severe, and between OPM and NPM, it is not that severe also. You agree? तो ये उतना severe भी नहीं है, हालांकि reduction तो है, which is obvious because your net profit margins have to be lower than your GPM and OPM. Now, can we also calculate ROCE, return on capital employed? So return on capital employed, we can take EBIT divided by, you can take either closing capital or you can take average capital. So if I take average capital employed, now यहाँ पे ना आपके पास choice है, either you can take only long-term debt or you can take the entire capital employed. I will take the entire capital employed. So EBIT is 350 divided by capital employed is how much? Capital employed will be debt as well as equity, right? So 350 divided by, in fact, I should, if I take just long-term debt and equity, it will be 610 plus 1020. This is for the current year, and previous year will be 690 plus 880. And this will be divided by 2, right? Average capital के लिए. Correct, no? Which comes to 21.875%. Now let's quickly see what the solution manual says for these. Okay, there's nothing much in the solution, so I think what we have done is okay. What about return on equity? Return on equity is fairly straightforward. So you can take net income, which is 200 divided by average equity, which is 1020 plus 880 divided by 2. That is also coming out to be 21.05%. Right? Now here आप देखोगे कि your return on capital employed and return on equity is quite quite healthy compared to your NPM and OPM, which probably means that the sales aren't that great, but the margins are good from a capital perspective, isn't it? Now, what about solvency? Rather, we should do activity first. So if I just take ITO, inventory turnover ratio, that will be cost of goods sold, which is 3,000, divided by average inventory. 310 plus 290 by 2 is 300, isn't it? Which means your inventory turnover ratio is 10 times. Is that right? Which means that my inventory conversion period is 365 by 10, which is 36 and a half days. Is that right? Now, next we should compute our debtors turnover ratio. So debtors turnover ratio will be sales by average receivables. So 4,000 divided by average AR. So your average AR is 200, right? 295, 205 plus 195 by 2, which is 200, which means that your DTO, debtors turnover ratio, is 20 times, which means that you have a very, very good receivables collection period. 365 by 20, which means you're managing to collect your receivables in almost 18.25 days. Now, if you know the concept of operating cycle, you know that operating cycle is nothing but your RCP plus ICP. So we get an idea that an operating cycle would be 36 and a half days plus 18.25, which is almost 55 days. But this is not your cash conversion cycle. This is your total operating cycle, because operating cycle क्या है? The time that elapses between the company converting the inventory from raw material stage to finished goods, selling it, and then collecting the money back from the customers. ICP plus RCP. And that is the other way to look at it, is it is also equal to payables collection period plus cash conversion cycle. So next step, we should compute your payables turnover ratio, which should be cost of sales by average payables. So cost of sales के लिए क्या लोगे आप? Will you take only cost of goods? I will not do that. I will take cost of goods plus OPEX, which is 3650, divided by average payables is 100, right? Which is 36 and a half times. इसका मतलब इनका payables conversion period और बेहतरीन है. So it will be 365 by 36.5, which is just 10 days. So they are paying their suppliers much faster than they are getting the money from the customers. तो इनके कोई भी periods high नहीं है. Neither the inventory conversion, nor receivable, nor payable. So now we have got the operating cycle also and the payable conversion period also. So we are ready to find out our cash conversion cycle, which is OC minus ECP. That means this particular company takes about 45 days to for cash conversion. The time that is taken to, or the time interval that elapses between the payment to the suppliers and the receipt of money from the customers is almost 45 days. Is that clear? This is from the activity perspective. Now, the last part will be the solvency. So what will be, I think the best ratio to assess long-term solvency would be your debt ratio and debt equity ratio. So debt equity के लिए I would take long-term debt by equity. So long-term debt currently is 610 divided by equity, which is 1020. That means this company, as I had expected, is got a fairly decent debt equity ratio, 0.6, right? And which means the debt ratio will be how much? Debt ratio will be 610 divided by, uh, sorry, 610 divided by 1020 plus 610, correct? Which is almost 38%. That means that the company has almost 38% of the capital as debt. I'm talking long term, which is the reason why the ROE is good. The reason they are able to get a decent ROE is because of financial leverage that they have in terms of the slightly good, I would not say very good, not optimal, suboptimal, but fairly decent debt equity ratio, right? And yeah, so I think that will complete the, we'll also have a look at the solution once, what the CFA manual has to say on this, and try to compare our results so that, uh, so this is the case that we have. So we got current ratio as 1.9, which is correct. Quick ratio, asset turnover. So, okay, so we have to calculate, we can also calculate as a part of activity ratios. We can also calculate asset turnover ratio, which will be sales by average assets. So 4,000 divided by average assets. What will you take in average assets? I will take total assets. So 2060 plus 1940 is 4,000 by 2 is 2,000. So 4,000 by 2,000, that means you have a, now this is good. So one of the reasons probably that the company, despite having low OPM and NPM, having a good ROE could also be because of a good ROA. अगर आपका एनपीएम कम है लेकिन एटीओ ज्यादा है तो आपका आरओए ज्यादा हो जाएगा. रिमेंबर, एटीओ एसेट टर्नओवर इज एनपीएम into, sorry, ROA, return on assets, is NPM into ATO. NPM is what? Net profit by sales. ATO is what? Sales by assets. तो दोनों को मल्टीप्लाई करोगे तो net profit by assets आएगा, which is ROA. So if you are, even if you are not doing good on your profit margins uh, because you are not generating enough revenue, even then I would say that if your ATO is good, if your assets are efficient and your asset efficiency is high, you can still be able to garner and generate a good return on assets, which is what has happened in this organization, right? So that is something that I could interpret. Going back to the solution, uh, return on equity, they have mentioned 21.15, 21.1, which is, I think, what we had got also. That is correct. Uh, Debt to equity ratio. Okay, so they have taken total debt. Now, if you, as I mentioned, this is quite debatable. You can take long-term debt also, you can take total debt also. So I have just gone by total debt. But I think that pretty much sums up the entire inferences, a comprehensive analysis of the financial statements, both P&L and balance sheet from a liquidity perspective, activity perspective, profitability perspective, and long-term solvency perspective. Okay, thank you.